Hey everyone, welcome to another video by Stocktrades. My name is Matt, and today we are going to take a look at some stocks that investors should take a look out for the balance of 2022. But before we do so, it's time to pick our monthly winner. If you've been following us, we have committed to giving out one Stocktrades premium membership every month to somebody who comments on our YouTube videos. So with that in mind, we are going to do that right now. So I'm going to turn to my YouTube picker and we are going to see who the lucky winner is for the month of February. As you see here, I've got our video loaded up with respect to the one that had the most views and comments. I'm going to grab the YouTube comments, the number of unique comments, and we're going to start the raffle and we'll see who the lucky winner is. Ready? 1, 2, 3. So congratulations to David Dowling, who is our lucky winner of a 1-year subscription to Stocktrades Premium. So David, please ensure that you email us, reach out. Our email is in the description below. Reach out to us and we'll get you all settled up. For everyone else, there's still plenty of chances to win. We begin the March promo with today's video. So make sure that you like our video, subscribe to our channel, and comment below. Remember, if you don't comment, you can't win. So with that, let's get to 3 stocks that investors should be looking at for the balance of 2022. The first stock on our list is TFI International. If you've been following us for some time, we have spoken about TFI International a few times, but it is one that we have strong conviction in. TFI International is one of the largest trucking companies in the country, and it has performed admirably over the past number of years. There was a period of time where TFI International was relatively flat, but it was significantly undervalued during this period of time. If you go back 5 years, the company was only trading at about $33 per share. Fast forward today, and TFI International is trading at close to $132 per share. That's equal to about a 300% return over a 5-year period. The company is also a Canadian dividend aristocrat, as it has an 11-year dividend growth streak. Over this time, the company has raised dividends in the mid-teens as it has grown at an exponential rate. The yield may not seem all that attractive at around a percentage point. However, the company's dividend growth rate more than makes up for this. Now, one thing I wanted to touch on with respect to TFI International was the impacts on vaccine mandates and the subsequent trucker protests that happened here in Canada. So our Stocktrades Premium members brought this up as a concern, and we were talking to them back and forth. Some of them were questioning whether or not they should sell their TFI International stock because of this protest and how it would impact the stock. Now, this is a great example of how investors need to take a step back and wait for the fundamentals. Look at the fundamentals and don't let your emotions take hold of your investment decisions. So our response to them was, let's wait and see what the company has to say. We knew that TFI International was going to be releasing quarterly results soon, and we said, let's wait, let's see what the company has to say, and then perhaps that'll influence our decision making. But there's no sense in making a decision based on simply what's happening anecdotally on the news. So interestingly enough, TFI International, when they released their quarterly results this past quarter, did in fact comment on the current situation. And it was a question posed by an analyst. And I'm just going to paraphrase effectively what they said on that quarterly conference call, which was in effect, that has had pretty much no impact. So why is this? Because the majority of TFI International's truckers are actually vaccinated. Ultimately, the company said that they work very closely with their staff and their truckers to ensure a high vaccination rate. Ultimately, though, it is a decision that they did leave up to their truckers. However, since the majority are vaccinated, they didn't have the issue crossing the borders. And they did this because they knew that this was a potential to happen. Now, the interesting part is because TFI International has such a large presence in both Canada and the US, for those truckers that weren't vaccinated, it wasn't an issue either because they just rearranged the routes so that they wouldn't have to cross the border. So it was kind of an interesting response. On the one hand, we had the news and we know how much coverage this protest received, and that in turn led to some anxiety for investors, especially those who were investing in trucking companies, and that could have led to some, rash decision making. However, taking the time to sit back, wait, and see what the company had to say, you see here that it really wasn't an issue at all. So there was no reason to sell the company based on these particular protests. So that's just a really good example of how investors really need to take emotions out of the equation and let the fundamentals, speak for them. Nothing changes the investment thesis in TFI International with the trucker protests. And that was made clear by the conference call. In fact, the company even came out and said that January is expected to be their best January on record. So really, at the end of the day, TFI International is doing just fine. It remains attractively valued. It has a high growing dividend, and it's simply one of the best trucking companies to own in North America. Next up, we're going to talk about Goeasy. If you've been following me for some time, and this predates my Stocktrades days, this is, when I was first starting to tweet, first starting to write for Seeking Alpha, you'll know that I'm a big fan of Goeasy. And the reason was, especially back then, was because the company was significantly undervalued, especially based on expected growth rates. It was trading at significantly low PE ratios, especially compared to its peers, and yet it did nothing but perform. I've been following this company since about 2011. Interestingly, since I've been following it, the company has never missed this guidance. Not once. It hit all its targets every year. That is a pretty impressive track record. That's a decade's worth of a company nailing targets and never not succeeding. So that to me is very attractive. That to me means that Goeasy has a very good handle on its business and an excellent management team. Since 2001, Goeasy has grown revenue by a 12.8% compound annual growth rate. That is hugely impressive. Not only that, it has managed to become a Canadian dividend aristocrat. It now has a 7-year dividend growth streak, over which time it has averaged 30% plus annual dividend growth. That's impressive. The company most recently announced a 38% raise to the dividend, and the company is effectively going to extend its dividend growth streak to 8 years. So this is a company that is not only growing earnings at a double-digit clip, but the company is also growing the dividend at a pretty high rate. The other factor to consider with Goeasy is the fact that now, will the company be able to maintain this level of dividend growth? Not likely, but that doesn't mean investors can't expect considerable growth over the next few years. The company, as mentioned, is expecting growth in the mid-teens, so this will support considerable dividend growth over the next years, considering the fact that the company's payout ratio against earnings currently only sits at 15%. Its 5-year average is about 21%, so you're looking at a company that is well positioned to raise dividends for years to come. Now, why are we talking about it today? Because every once in a while, Goeasy goes through these big dips, and we are in one of those double-digit dips where Goeasy has got swept up in some negative momentum and is now trading at below 10 times earnings. This is a very attractive entry point for Goeasy. Anytime the company drops to this level, we think it's an opportunity for investors to buy. It has proven to be such an opportunity historically, especially considering you are now paying under 10 times earnings for a company that is growing at a double-digit pace. That is a very attractive combination. All this being said, we do get criticized at times, as do I, because of the ethical implications behind Goeasy and their predatory lending practices. So important to remember that this investment may not be for everyone. So just keep that in mind. We're aware of this, but it also plays an important service in the market, something that goes unnoticed. It typically serves clients that the banks turn away. So there is a need for companies like Goeasy in the market today. Now, that being said, once again, everyone has to make their own investment decisions and decide what investments are most appropriate for them. Next up, we are going to talk about oil, which, one can also argue is an ethical implication as well. But today we are going to be talking about Canadian Natural. We all know what's happening in the unfortunate events that have unfolded over the past couple weeks. We talked about it in our Stocktrades Premium Discord. These types of situations, the Russia-Ukraine situation, can lead to a lot of anxiety. It can lead to a lot of uncertainty in the markets. So, we do encourage investors to really ensure that they are prepared for this volatility. Mental health is obviously important to everyone. So we need to make sure that, what you're invested in, you're comfortable in, and that, you're not freaking out over your investments. You're not, making rash decisions based on the events that are happening. That being said, one of the side effects of the Russia-Ukraine war has been an increase in oil prices. We know there's been a disconnect on the supply demand side of things for oil, which has led to an increase in oil prices since mid-pandemic. We also know now that in these times of uncertainty, especially with Russia being such a major oil player, that we are seeing increased pressures on the price of oil. In fact, when news first broke, the price of oil reached I think $105 per barrel, which it had not seen since, for a decade. So we are talking about high oil prices. Right now it's around $91 per barrel. So a company like C&Q, which has a break-even point of $30 per barrel, is well positioned. It's generating considerable cash flows at these levels. Dan mentioned in one of his previous videos that C&Q generated more cash flow in the first few months of 2021 than it did in all of 2019 and 2020. And that goes beyond, what's currently happening here in Russia, Ukraine. We know that inflation has an impact on oil prices. We know that we are in an inflationary environment, so this is going to lead to higher oil prices. So all these factors are all playing together. And a company like C&Q is going to benefit. By the time you watch this video, C&Q will have reported their annual quarter results, and they'll probably have announced their annual dividend raise as well. The company is currently sitting on a 21-year dividend growth streak, and it has averaged double-digit growth over the past 10 years. It is going to be, since it's generating record cash flow, we can expect another double-digit raise. I'm expecting 20% plus, if not more. We likely seeing significant share buybacks. The company is going to be deleveraging. This is just a really good situation for Canadian Natural. As one of the lowest oil cost producers in the country, C&Q is ideally situated. Not only that, let's put everything else aside. Let's assume that the price of oil now goes into a bear market. Well, guess what? C&Q, as the lowest cost producer, is still better positioned than any other producer in the country because it can sustain a prolonged bear market. Just like it did before the most recent rise, C&Q is still raising dividends and was still doing quite well despite the fact that we saw some pretty low oil prices. That's because it's a low cost producer. And now it's even more laser focused on reducing that debt. And with the amount of cash flow it's generating right now, it's going to be, reducing its share count, which will also help the company in the event that the price of oil turns. That's why we like to invest in best-in-class stocks in the commodity industry. And we believe that C&Q is, quite frankly, best in class. So there you have it. 3 stocks that investors should consider for the balance of the year. C&Q we've talked about a few times in recent weeks, but there's a reason for that. The environment is setting itself up for oil, and we think that investors should have some exposure here. And we think that C&Q is simply one of the best ones to own. So outside of going with an ETF like XEG, we think that Imperial Oil or C&Q, these are the ones that you're going to want to own. Then we have TFI International and Goeasy, 2 stocks that we haven't talked about in some time, but we've talked about many times on this channel and many times over our Stocktrades Premium. We think that these are just 2 companies that have seen some recent pullbacks and that are now trading at attractive valuations again. So we think it's time to be looking at these again. And once again, a big congratulations to David, who won the free year's membership to Stocktrades Premium. And for everyone else, don't worry, there's lots of opportunity. Just remember to comment on the video below. This time, let us know which one of these stocks are your favorite. Do you prefer Canadian Natural, Goeasy, or TFI International? Comment below and you stand a chance at winning our March promo, which once again is a free year's subscription to Stocktrades Premium. Thanks everyone, and as always, like the video and subscribe to our channel for more great Canadian content. Until next time.